Hello, traders. FS Collector here. Today is Wednesday. It is July 30th. So, how is everybody doing tonight? Hopefully, fairly good. Maybe it's not tonight for you. Maybe it's good afternoon. Maybe good morning, depending on where you are. It's kind of good evening for me. It's right around 6:30 p.m. my time. So, we are getting ready to preparing for the FOMC, the federal funds rate. Now, a couple different resources that some of my members were pointing out to me today and yesterday is that people are forecasting that the chances of them changing rates is extremely low, like 5 to 10% chance that they will actually end up changing rates. So we're gonna have to see how what happens with that. Let's see here. Just give me 1 second. So, anyways, yeah, we're gonna have to see what happens with this. More than likely, they are not going to be changing rates. The rate right now is 4.5, and they most likely are going to keep it at 4.5. A lot of people definitely think that they should be lowering rates. I mean, obviously, Trump thinks that. They definitely are not getting along very well because of it. Um, and honestly, the numbers really don't look that bad. I think the only thing that is keeping Powell from lowering rates is definitely the tariff news. And the fact that they worked out a deal with Europe this week, at the beginning of the week, is actually good news because, we got to deal with the UK and Europe and a bunch of other countries. So potentially, this tariff war bull crap that we've been dealing with so far this year, hopefully we'll be getting closer to the end and we won't have to deal with that anymore, hopefully soon. So, anyways, we get the news in just under 30 minutes, as you can see. But then 30 minutes after that, which is about an hour from now, we get the press conference, and that's when Powell is going to come on and talk. I got it queued up right here on CNBC, but you can go on the Federal Reserve YouTube page and find it there also. So we got Powell talking in 56 minutes. Normally, what happens at these news events is, you'll get a pretty decent move right at the news, which is in 30 minutes. You'll get a pretty decent move, but then a lot of the times it will make a nice move, and then it'll come all the in the 30 minutes it takes for the press conference to start. A lot of the times it'll come all the way back to the starting line, like right where it was before the news came out. And then it'll kind of bounce around for a little while Powell is talking, and then later on, up to 90 minutes after the news is actually over is when you usually start to see the market go, one way or the other and actually start to agree on a direction. It's going to make a big difference on whether they actually do end up changing rates or not. I mean, if they do not change rates, it's probably not going to really be a surprise to the market. If they do change rates, especially with everybody forecasting a very, very low percentage that they are going to change. So if they do surprise people and change rates, that's going to be a big surprise to the market. When the market is surprised is when you get big, big, big moves. So you never know. I mean, maybe they will change rates. So I'm going to start off on this US dollar index on the 4 hour time frame. One of the guys in my free Discord channel was asking me to look at the DXY. Now, one thing to keep in mind is I analyzed the US dollar index. Why? Because it's equally weighted. It's equally weighted between six of the US dollar pairs. So in my eyes, the US dollar index is a way better representation of what the dollar is doing than the DXY is, especially right now because of all the movement we've had with the euro. The DXY is actually quite a bit different than the dollar. I mean, it's still very, very similar, and I really don't think it makes that much of a difference whether you analyze the DXY or the dollar index. I just, because people always ask me why I don't analyze the DXY, and it's because it's equally, this one, the US dollar, FXCM US dollar, is equally weighted. The DXY is 56.5% weighted to the euro dollar. So when the euro is moving a lot, like it is right now the euro is moving a lot because of all the tariff news that we've had lately. The DXY will actually start to look a little bit different than the US dollar index because the DXY is literally exactly the same picture as the euro dollar. And it doesn't take much to really realize that. If you take the euro dollar and you overlap it on to the DXY, it is like literally exactly the same thing. exactly the same picture. That's why I don't analyze the DXY. But there's really nothing wrong with the DXY. And the thing that is good about the DXY is that everybody uses the DXY. You know, big institutional traders, hedge funds, everybody uses it. So support and resistance areas do often work really well on the DXY compared to the US dollar index because the US dollar index is definitely a lot less used than the DXY is. So that's just I wanted to talk about that for real quick. If I actually leave this euro dollar on here and then I go to the US dollar index, I mean you can see that it's still very similar, but compared to the DXY, the euro dollar is definitely not as correlated because of the fact that DXY is 56 or 57% correlated to the euro dollar. So anyways, let's start off with the US dollar index. So last week I was saying that this potentially was a running ABC, and I was saying that that potentially was the end. Now we got the end of a trend, and prices kept on making higher highs, higher lows. You know, we had to kind of reevaluate things. So I was looking at it yesterday, and I was thinking, okay, what if this is impulsive up, wave A, one, two, three waves down, wave B, impulsive up, wave C. So A, B, C, and then we have five waves down, one, two, three waves up ending right here. So five waves down, three waves up, and then five waves down equals another A, B, C. So you have an ABC and then another ABC. Now we have impulsive up, corrective down, and impulsive up. In my eyes, this is the third ABC pattern. It looks like a triple three pattern. It looks like a triple ABC, which is a WXY in Elliott wave terms. So three waves of W, three waves of X. I think we potentially have three waves of Y. And one of the major reasons why I'm still very bearish on the dollar is because these higher time frames. I mean, yes, we definitely did bounce pretty hard right here, but another reason why I think the dollar could possibly turn down is because we just made a little bit of a, we just took the highs out of the previous month candle. So there's going to be a ton of liquidity right here, which I think could help push this down. But I still think that the dollar index needs to go down quite a bit more. I still think this potentially is going to go down here or maybe even down here, which is still, this is the monthly time frame. So that's potentially the whole year of down potential. But that's the monthly time frame, and none of us are really trading the monthly time frame. That's way too high of a time frame for even me, who I definitely consider myself more of a swing trader for sure. So, anyways, on these sort of time frames, the question is this getting ready to end a trend? Because an A is a trend, a B should be a correction, which honestly that looks more like a trend also, and a C should be a trend. So how do you identify the end of a WXY? You identify the end of a WXY by identifying the end of a trend for the wave C. I tell my premium members almost every single Zoom meeting that I do, if you learn how to tune the frequency of your charts and learn how to identify ends of trends, you know how to identify ends of corrections also, because a correction is just a trend with a correction in the middle and then another trend. So if you identify the end of this third trend, which normally is a wave C, then you've also likely identified the end of a correction. What happens at the end of a correction is it will go down and take out the low of wave A normally. So we'll have to see if that's how it's going to play out or not. But right now, it definitely does kind of look like that. One thing that kind of throws me off a little bit about whether or not it's really done or not is we're actually still a little bit from the 100%. The 100% Fibonacci extension of wave A projected off of wave B is right here. We have not hit that level yet, which means, you know, it could possibly keep going up. And, you know, it could turn down later on this week during like non-farm payroll. Because if you look, we have a lot more news this week besides just this news. At the end of the week, we got non-farm payroll, which this non-farm payroll comes out while I'm in a Zoom meeting with all my premium members. And if anybody is interested in that, definitely check out my website right here. There's a short little video you can watch right here on the homepage that literally explains everything. So definitely check that out if you're interested. It's fxpipcollector.com. But anyways, so that at the non-farm payroll news that we got coming out on Friday, we will be in a Zoom meeting at the time of that news. seeing if there's any potential trades during that time. And we also have IMS manufacturing this week, which is also another really good news event. So we definitely have a couple pretty good news events coming up for sure. So, anyways, we got a limited amount of time here to get going. So let's see here. We have 19 minutes until the news drops, 18 minutes and 30 seconds. So my whole point is, I like to, if I'm trying to trade any of these US dollar pairs, I want to know what the dollar index is doing. If I think the dollar index could end a trend, that means that the exact same movement would happen on all six of these dollar pairs. So if I know what the dollar is going to do, or if I have a good idea of what the dollar could do, then I also literally know what to do on every single one of these dollar pairs. So, a lot of people are like, oh, can you look at the, euro dollar, pound dollar, Aussie dollar? Well, looking at the dollar index literally just told me what to do on every single one of these pairs, except for maybe gold, because gold doesn't really care about the dollar index that much. And the US dollar yen sometimes is more of a yen pair than a dollar pair, but definitely the euro dollar, pound dollar, Aussie dollar, Kiwi dollar, dollar cat, dollar Swiss all follow the US dollar index. So if you have a good idea of what this is going to do, then you have a really good idea what to do on every single one of the dollar pairs themselves. So right now I see that the US dollar is in an uptrend. I see that maybe we could get like a little bit of a spike up to grab one of these higher fib levels. And then I see that if it does start to go down, if it does break structure, that is likely the end of a third three-way pattern on the daily 4 hour, and that is likely the beginning of a brand new downtrend. So now that I know that, which I'm on the 2 hour time frame, sorry about that. Let me go to the 1 hour time frame and zoom out a little bit. So now that I know that information, now that I just spent, 12 minutes analyzing the US dollar, I literally know exactly what to do on the euro dollar. Maybe we're going to get a little push down, grab some liquidity, but if it goes up, if it breaks structure, that is likely the end of the beginning of a brand new uptrend. That would likely be a wave A, a wave B, and a wave C. It doesn't have to go up and break structure. This is something I try to make clear in all my videos because people, they'll see me draw something like this and they go long. Well, I will only go long if I see this picture. I'm not going to go long unless I see that picture right there. So people will see that and they go long and then it goes down and they're like, oh, what happened? I'm like, well, it never broke structure at a Fibonacci level, so it was never a trade. So the point I'm trying to make is that technically we should still be looking for shorts on the euro dollar unless we see a break of structure. The most recent break of structure is way up here, so the euro dollar would have to go way up there to prove to me that it's a wave C. If you enter now, then it's probably not a huge deal, but just keep in mind it could just literally go down and keep going down. This might not be an ABC, it could be a 1, 2, 3. On the very high time frames, it definitely looks more like a 1, 2, 3 in my opinion. It looks like a 1, 2, possibly even a wave 3. This thing could do this over the next, on the daily time frame. It could end up doing this 1, 2, 3, 4, 5, maybe even go all the way down to this low of wave 4. So the trend is your friend, and the daily, I mean, technically based on structure, it's up, but we got a significant lower high, and the market flow is definitely down. So the trend is your friend, which means technically you should be shorting the dollar. So that's definitely what I'll do with that. Then the pound dollar is literally exactly the same story. The pound dollar, same type of thing on the higher time frames. It looks more like a 1, 2, 3 to me. This thing could literally stretch out to like the 161.8. This could be a wave one. This could be a wave two. This could be a wave three on the daily. So even though on the 1 hour time frame I have this possibility that maybe it could go up, I'm not going to go long unless I see that break a structure at a Fibonacci level. So when I go down to the 1 hour time frame, I start thinking something completely different. I'm like, oh, this might not be a 1, 2, 3. Maybe this is an ABC. I'm like, okay, this could be an A, this could be a B, this could be a C. If it goes up and if it breaks structure, that's the end of the correction, continuation of the uptrend. If I see this picture, I would go long on the first pullback. If I don't see this picture, I would continue to look for shorts every single chance I get. Like literally, just looking at that US dollar index told me exactly what to do on every single one of these dollar pairs. I spent 12 minutes analyzing the dollar index. Now I know exactly what to do on every single dollar pair. The Aussie dollar is quite choppy for months now. I mean, if you go out to the daily time frame, I don't have to draw a channel on here to see that there's a pretty damn clear channel on this thing. It's like literally just for months now, just been bouncing up and down, up and down. So I mean, it doesn't take a expert technician to see that we're likely at the bottom of a channel and we could get a pretty good bounce right here. And because of the weekly and the monthly, if this really is a one and this really is like a running WXY type thing, it could be a wave two and it could go up for wave three. So we have to keep in mind those very, very high time frames because a lot of times, you'll come up with a really good analysis on the weekly, monthly, daily. Then you go down to the 1 hour time frame and you start coming up with stuff that's completely opposite what the daily, weekly, monthly tells you, which means more than likely your sort of time frame analysis is incorrect. So right now, the most recent structure on the Aussie dollar is right here. This thing could go up and then down, and it would still be a downtrend because there would be no break of structure. So technically, for me to know that this is going up, it would have to go all the way up to here. Then it would have to pull back, and then I would go long on the pullback. I know that's a lot of waiting, and patience is like the one thing that retail traders do not have. But right now, we should be looking for sorts. We should be looking at anything we see to the upside as possibly an opportunity to go short, unless it breaks structure to the upside. If it does go up and break structure to the upside, then we should wait for a pullback, and then we should go long on the pullback. So the it's really quite simple, honestly. The problem is us. The fact that we don't have patience, the fact that the news is going to come out and it's going to spike up and everybody's going to instantly have FOMO and try to go long, and then it's going to come back down to the starting line, and then it's going to bounce around and everybody's going to be going long and short and all kinds of crazy stuff. Kiwi dollar is exactly the same as the Aussie dollar. We should be looking for shorts unless it breaks this high. If it breaks that high on the first pullback, we should go long. US dollar CAD, I really still think that this US dollar CAD might go down one more time on the daily. I mean, to me, this really looks like the shape of an ABC, not a 1, 2, 3. If it was a 1, 2, 3, I would say, oh, it's going to go up and take out that high. But I think this is going to go down and take out these lows on the weekly time frame. So overall, I'm still bearish. I'm still looking at this as potentially a opportunity to go short, maybe. The question is it going to go higher or is this level going to hold? Boy, this one is actually one of the ones that I was really tempted to enter. We're at the 100% Fibonacci extension. If it goes down, if it breaks structure, then I will know that that is the end of a correction and that is in a brand new downtrend. If it doesn't do that, then I potentially could, do that, make a higher low, and keep going up. Technically, we should be going long, and we should be looking for longs until we get that break of structure at a Fibonacci level. Right now, our most recent structure is way down here. So this thing could do this, make a higher low, and then just keep going up if it wants to. Or it could go down and break structure, then make a pullback, then we would go short on the pullback. Which you have to keep in mind, this is the 1 hour time frame, so a pullback entry probably wouldn't even happen today. It would probably happen like tomorrow or something, or maybe even Friday, if that's what it does. Hey, Chrissy, how's it going? Nice to see you. The US dollar Swiss is another one that really makes me think that the dollar is going to go down at some point because to me, this really looks like a crutch into this last wave down. I think that this is the five waves right here. I think that's like a leading wave A, and then you have 1, 2, 3 for the wave B, and then you have 1, 2, 3, 4, 5 for the wave C. Maybe it will shoot up a little bit just to grab some liquidity in that Fibonacci level, but I think it's going to go down at some point. I do think that potentially it's going to go up first just because it might want to grab some liquidity, but overall, pretty bearish. And even the dollar yen, I literally got my analysis for all six of these pairs by analyzing the US dollar index. By analyzing this and spending a good amount of time trying to figure this out, I was able to know exactly what to do on all six of these pairs. All the euro dollar, pound dollar, Aussie dollar, Kiwi dollar, US dollar CAD, US dollar Swiss, and the US dollar yen to an extent. I still think the US dollar yen is an ABC correction on the daily. That's why I'm still looking. I mean, this is extremely overlapping. I mean, how can this not be a correction? I mean, I guess it doesn't have to be a correction, but I think this is a pullback to this last wave down. I think this is gonna make a. I don't think it's gonna make a break a structure. I think it's gonna make a lower high and go down again. So zooming in, is it gonna go down today? I mean, it doesn't have to. It could go up another couple hundred pips if it wants to. It could go up to grab some of these highs and then go down. So I am definitely looking for a reversal. I just don't know if it's gonna happen today or if maybe it'll happen next on Friday, non-farm payroll. Going down to the 4 hour time frame, this is our structure right here. If it goes down and breaks that, then that probably is a wave C, and this is probably like a run 1, 2, and it's gonna go down and make a wave 3. If it doesn't break this structure, anything you see to the downside could potentially just be a pullback within a uptrend. So literally, every one of these dollar pairs is the exact same story. Until we get the break of structure, we do not know that anything that happens to the downside is anything more than a pullback unless it breaks structure. So you potentially could get in some of these trades if you really wanted to, but there's zero proof that they're going down right now. The market is really the only one that really knows if it's going to go down or not. Hey again, Billy, how's it going? Let's see here. So we'll have to see what we got. About 8 minutes until news comes out. It's definitely looking like it wants to turn to me. Oh, and gold. I'm sorry. We gotta look at gold. People are gonna have a heart attack if I don't look at gold. I see the first messages that came in with gold. I can look at platinum for you, but I'll probably have to do it after the news comes out. So after the news comes out, we're gonna have about 30 minutes of downtime, waiting for Powell to start talking. That 30 minutes in between the news coming out and Powell talking, the press conference, is when I'll take requests. So I'll look at things like platinum or whatever people want me to look at. We'll see what happens. I wouldn't count on the euro going up, honestly. I mean, really, you cannot count on the euro dollar going up. I personally think that the gold is in a downtrend that is probably going to take several weeks to play out and probably going to go down to about $3,000 an ounce. That doesn't mean it might not make a decent little rally on shorter time frames, though. It'd be pretty damn common if it did something like this, wouldn't it? I think this is a W. I think this is an X. I think this is an A, B, C of wave Y. So I am extremely bearish on gold. I was actually short on gold. I made a 700 pip trade on gold. We went short up here right before the break of structure, and I got out right down here somewhere. So I made about 750 pips on gold this week, and every single trade I do take is shared with my members at the exact time of entry. So definitely check out my website if you are interested in that. I definitely do not intend it to be a signal service. I am just one trader sharing all the trades I get in. So it's not really technically a signal service. I just, I share every single trade I take. So if you are interested, check out my website. Watch the video on the homepage if you want to learn more. Now, it definitely does look like something that could go up to me. It could possibly start a wave two. And a wave two, I think, would probably go up to at least probably 3360 or so, whatever that is. Yeah, 3365 at least probably before it went down. The problem is there's literally zero proof that it's going to do that because I am extremely bearish on the daily and weekly. What's stopping this thing from doing this and then making a lower high and a lower high? Because that's what happens when you're in a strong downtrend, right? You get lower lows and lower highs. So there's no reason to say that it might not do, it might bounce up kind of like what happened here, but then make a lower high, make a lower high, make a lower high. So it could bounce and then make a lower high, go down. Or it could go up, take out the high. This would be a 1, this would be a 2, and then it would spend probably at least a week making a wave 2 and then go down, maybe in a week for a wave 3. So there's definitely a few possibilities on gold for sure. Definitely would not disagree that it looks like it's going to go up. But yeah, it's definitely a little bit of a coin flip for sure. I totally agree with that. I do have a couple dollar trades open that I'm going to keep open for the news, but they are literally like coffee money trades. So it's very small risk. And if they work out, then fine, make a few bucks, buy dinner for the weekend or something. If they don't work out, then I lose, coffee money. I guess probably Starbucks money actually, because it's definitely more than a coffee. But let's see here. Yeah, so I'm gonna see here. I don't know. I'm kind of convinced myself that the dollar is gonna go down, but I might get trapped. And if I am, it's not that big of a deal to me because it's not gonna be that much money if I do. So the last couple of FOMCs, I didn't even trade it. I didn't trade out the news, like trying to enter something right at the news. But more times than not, I do try to have some sort of a position open during the news, but usually it's very, very low risk positions. I'll be risking like 0.1% of my account or something. So if I'm wrong on two positions, maybe I lose like 0.25% of a percent, quarter of a percent I'll lose. So it is what it is, right? At that point. I have three trading accounts. I have a $50,000 funded account, which I trade with my member. Oh, I try to trade it with my members. This is my 50K funded account. I have a $100,000 account with Darwin X, and I have my own personal account, which is about $35,000. So between all three of my accounts, I'm trading about $185,000. So if I could make, you know, 3 to 5% is kind of 2 to 5% a month is kind of my goal. If I can make 2 to 5% a month on $185,000, I'm pretty damn happy with that. That's for sure. So, anyways, oh yeah, I know that's such a. I'm kind of sick of it, honestly. The Powell Trump drama. Honestly, Trump is a very dramaful person. I am definitely a Republican. I'm from America and I'm a Republican, but um, it does get kind of sickening, that's for sure. All the drama. I hate drama. The markets have been a little unpredictable when they move. I don't know, man. I could see it going either way, to tell you the truth. It doesn't look like the euro dollar is quite finished. It might go. I think it could go down, grab liquidity before it goes up. Maybe go down to like the 138 or something before it goes up. Kind of depends on whether they change the rates, I think, too. It's definitely going to depend a lot on that. We got 1 minute and 2 seconds until news comes out. So let's see what happens. I got a few trades going, but like I said, they're all pretty small trades, so not too. I'm not going to put on a full percentage during FOMC. That's for sure. Let's see here. So we got 30 seconds. Yeah, they're not going to change rates. Somebody in my members area said that they were forecasting like a 5 to 10% chance of a change of rates. So they're forecasting that there's like a 5% chance that they will change rates. So more than likely, they're not going to change them. We got 15 seconds until the news. And then we got 30 minutes to wait for Powell. So I'll start taking requests after the news comes out. I'll look at platinum because I see somebody wanted that, and somebody said the Canadian yen. Let's see. Here the news should be coming out. Most likely no change in rates because the thing hasn't jumped a ton yet. No, no change in rates. Honestly, they really should change rates. I think they have one of the highest interest rates out there now. The UK was even with the US for 4.5, but they ended up lowering rates a little bit recently. Let's see what happens. I want to give it a few minutes and then I'll look at platinum and I'll look at the Canadian yen and I'll take requests. I'll look at anything. I don't really mind looking at things I don't even normally look at. Like I'm definitely not a crypto trader, but I'll look at cryptocurrency. I'll look at stocks if you want, indices, pretty much anything. The thing is that structure analysis, Fibonacci analysis, and Elliott wave analysis kind of works on everything. Oh, you're backwards. The U.S. dollar euro. It's a euro dollar and it's gold versus the dollar. Yeah, we just looked at all of those. We spent about a half an hour looking at them. The trend is still very heavily down on the euro dollar, so I mean, anything we see to the upside could be a pullback until we get a bigger structure. So this thing could go up and then down it goes. There's nothing stopping it from going down more. The trend is your friend, 100%. Anything happen on gold? Yeah, gold didn't really do much either. Powell is going to move the markets, I guarantee it. I don't think the markets are going to move much until Powell starts talking. So we have about 29 minutes until Powell talks. So I will start taking requests from people in the chats. We got platinum, we got the CAD yen, and we got silver. I already looked at all the dollar pairs, including gold, and not really much is happening yet. But we will definitely circle back to the dollar pairs while Powell is right before Powell talks, because those are the pairs that are obviously more than likely going to end up moving during the news. Oh yeah, see the euro dollar definitely could push down. I already looked at all the dollar pairs, so let's go look at something else while we're waiting for the Powell to start talking. Um, I'm pretty sure Palladium was the first one, or was it Platinum? I don't know. Is the person still here to ask for that? Was it Palladium or was it Platinum that you wanted? I see the CAD yen, so I might start there just because Platinum. So let's go look at some stuff and take requests until the chats come out. Platinum, sweet. Let's see here. Platinum is that's Palladium, so this is Platinum right here. Yeah, that's Platinum. Yeah, I'll look at the S&P 500, no problem. I was forecasting a little bit more up, but oh wow, Platinum is turning down pretty hard, isn't it? Oh yeah, look at that. That could be an ABC finished right there. Look at this on the monthly time frame. Wow, this has been here for a long time. Get rid of that. Boy, that could be an ABC. This thing could potentially start a new downtrend, honestly. That's the monthly time frame, though. Let's see if we can identify the end of a trend. In order to know that that's going down, we have to be able to identify the end of this trend right here. Do we have a break of structure yet? Boy, the daily is pretty much where it's tuned correctly. Wow, I think I would be looking for sorts on this. This is all higher high, higher low, higher high, higher low, high low, high low, high low, high low, high. All higher highs, higher lows with a break of structure. I would be looking for sorts. I think this thing potentially could, in the matter of a couple of weeks or a couple of months, could go down and take out this low because this is the daily time frame. So obviously it's going to take some time. But yeah, boy, I think I would have to turn bearish on this. Not right now, obviously. Oh wow, look at that. Those are some beautiful pullbacks. When I see something like this, I always have to stop and appreciate it because boy, look at that. That is like a picture perfect ABC right there. One, two, three waves up and golfing down. That is almost a perfect ABC right there. One, two, three waves up and golfing down. One, two, three waves up and golfing down. One, two, three waves up and golfing down. Those are extremely beautiful trades right there. So what would I be doing on this? I would have to wait for one, two, three waves up and golfing down, add a Fibonacci retracement of the last wave. So I would definitely be looking for sorts. Maybe on like the 30-minute time frame, you could get a break of structure up, and once you do that, throw your Fibonacci retracement on the move down, and wait patiently for another one of these beautiful three-way pullbacks. Those are extremely nice. The yen pairs have been extremely consolidated because of other yen pairs, especially the JPY basket. I still think we might have a little bit more down on the JPY basket, which means I should think that we have a little bit more up on the CAD yen. I think the CAD yen's going to go up at least one more time, and it might even go up quite a bit. But because of other yen pairs, I think this is a running ABC. I think it's going to make a lower high, and go down. But whether or not it's doing it yet, I don't know. This all looks extremely corrective. Like this is all extremely corrective looking. It looks like it potentially is going to bounce from a fib level and go make a new high at some point. I mean, we've been in between these two lines, which means that we do not have a break of structure down, which means that the weekly trend is definitely still up and the daily trend is definitely still up. So anything we see in between these two lines, we have to kind of assume is very, very likely a pullback to this wave up. Because when a market is trending, every pullback is just a pullback to the last wave. Yeah, I'll circle back to the US dollar pairs in a little while. We're going to look at things other than the dollar for a few minutes, and then we'll circle back to the dollar pairs because the dollar pairs are definitely the main priority for us. I already looked at all the dollar pairs, so I spent about 30 minutes looking at them all, but we'll definitely circle back. I, uh, I mean, until it actually goes down and breaks structure, we would probably have to look at this as potentially being a correction, but we'll see. Oh, the SPX, yes. SPY, SPX. The trend is down on the pound dollar. The trend is down on the euro dollar. The trend is up on the US dollar yen. So if you are doing anything besides trading in the direction of the trend, then you're kind of gambling a little bit, especially at these news events. The trend is down. So the CAD yen, I would keep an eye on it. I mean, this thing could go continue the uptrend at some point. Kind of seems like it needs to go down, take out these lows though. So it might go down to the 78%, then do something like that, and then go up. So I think it might go down to like the 78% before it goes up. Or if it goes down and breaks structure, then you can hold on to your swing trade with confidence after the break of structure because that'll be way clearer that it's actually going down. I was forecasting a little bit more up on this. Excuse me. I was thinking it was going to hit the 161.8, which is right at the 64.5 area. I think we have one more little push up on the US dollar, uh, the indices, the S&P, the Nasdaq, and the Dow to finish off this wave five. I think this is actually an extremely good example of something that potentially everybody should kind of pay attention to because this is something that they teach right in the Elliott wave book, the Frost Proctor book. You have a wave one, you have a wave two, and then you have a wave three, and then a fifth wave extension. You can have a first wave extension, you can have a third wave extension, or you can have a fifth wave extension. I think this is an extremely good example of a fifth wave extension. So this is likely a one, two, three, four, five of five. So the wave five has a visible five waves, which puts me up to about the 64.50 area is what I've been forecasting. I think we might have just a little bit more up, and whether it goes up and now or not, I don't know. I mean, it definitely looks a little bit like an ABC, doesn't it? I think it could go up one more time, honestly, to that 64.50 area. I mean, if it starts breaking shorts into the downside, then obviously we need to start getting short, because if it ends a fifth wave pattern on the daily, it would probably at least minimum take out the low of wave four, which would put us down to 57.50. So that would be like my minimum target when we can finally confirm that this move up is over, is this right here. It might even go a little lower than that. DXY is breaking down. Good. To be honest with you, I am short a couple dollar pairs, $2 pairs. Well, yeah, I'm short the dollar via $2 pairs, but they're both very small trades. If they work, then I'll either look to get in more or add to it later on or whatever. Maybe tomorrow I'll try to get an add on to make it a little bit of a bigger position. Yeah, dollar is starting to move a little bit. Silver was the next request I had. So silver, go back to commodities. Silver's definitely not a pair I analyze on a regular basis, but I think once a week I make a video for it. Ooh, man, my most recent video I said that this is getting close to ending. I just wish it was at a Fibonacci level. The fact that it's not at a Fibonacci level makes me really think that yes, it might. I think there's a good chance it's going to go down, but I think it's going to make a higher low compared to this and go up at least one more time later on, which is probably pretty similar to what's going to happen to everything else. Hey, Skywick, yeah, we're going to circle back to the dollar pairs. We already looked at all the dollar pairs, so now I'm just taking requests for things outside the dollar. Oh, maybe that's an ABC. I don't know. It doesn't really look like an ABC. It looks like a complete pattern, doesn't it? Looks like a wave one, wave two, wave three, wave four, wave five, which means this is likely a one, two, three, four, five of A, and then probably end up doing something like this. Oh yeah, the VIX, the fear index. We should probably take a look at that. Is Are people fearful right now? Is the VIX really high? I know a lot of people that use the VIX to help trade the stock market and the dollar itself. When that thing starts getting really high, it can usually mean that there's a big reversal in the near future. So I think this is going to potentially do something like this. Oh, it's very low. That means people are not fearful. That means that people need to have a little fear in their lives, doesn't it? As in, potentially, the stock market could crash at some point. Yeah, I agree. When it's high, usually the stock market's going down. When it's low, usually the stock market potentially could make a little bit of a crash. Everybody has been forecasting a crash pretty much ever since Trump became president, and I've still yet to see it. So it's kind of funny in my eyes. So I think this is a wave A. I think it could potentially go up and start a move up, which kind of makes me think that gold probably will do the same thing. If this is getting ready to make a wave B, then gold is probably getting ready to go up and make a wave two because they are definitely correlated. And then eventually they'll both go down for either a wave three or wave C. Silver definitely looks like an ABC, not a 1, 2, 3, but it could end up being either or really. Let's see, what else do we got going on? Let's check out the DXY real quick. Let's see what's up. Yeah, I bet he's really writing some poetry for Trump, huh? What do we got? 16 minutes until Powell comes on. Him and Trump just had a get together was it this week? Yeah, last week, right? I think it was last week. They just had to get together. Very, very awkward. You can tell they do not like each other like at all. Like not even a little bit. Kind of funny in a way, but it's also kind of sad in a way because they should be working together, not fighting each other. I Yeah, definitely very awkward. That's for sure for them. I still think that the dollar is going to go down again. This is the DXY. I don't know if it's going to go down now, if it's going to go down later on this week, maybe during non-farm payroll. Because on Friday we got non-farm payroll, which is another really big event. And then what do we got? Oh, and then next week on Tuesday we got IMS manufacturing. That's another good one. What else do we got for the dollar? Unemployment, that's not that big of a deal. Oh, CPI is next week too, so the dollar potentially could turn next week, and it doesn't have to turn right now. I'm hoping it turns now, but with the fact that they didn't change rates, there really isn't much of a reason for the trend to change if there's no change in rates. It should just continue doing what it's probably gonna do. To me, this looks like a trend. I On the other one, I have it labeled more as an ABC, like this, ABC, which I could see that on this too, because one, two, three, four, five, and then A, and then one, two, three, B, and then one, two, three, four, five, C. So there's your A, there's your A, B, C, and B, and then C. 1, 2, 3, 4, 5 waves up for the A. So maybe it really is doing 5 waves up because this wave A has 5 waves. So maybe it's gonna do this, which is exactly what I was saying on the dollar pairs. I mean, it could definitely stretch out into this. I haven't seen the euro pound in a while. I mean, I do trade the euro pound, so I do watch it once in a while. Let's see what the euro pound's up to. I was waiting for it to see if it made a bounce, but it looks like it's trying to break structure. But I was kind of wondering if this could be an expanding. Is it possible this is an ABC right here, like a higher high wave B, lower low wave C, and then it continues up? Definitely possible. EU's breaking down again. You've been sorting EU all week long, haven't you? Getting little scalps and stuff out of it. That's awesome. The EU was always my favorite pair for years. I literally only traded this pair pretty much for years. Oh, that does look like it's going to go down again. We'll see if it does or not. Sometimes you don't get these wave fives like you would expect. Maybe it'll go down, take out this low, and then that'll be the final little, you know, there's probably a ton of sell stop orders right here because that's the break of structure level. So probably a ton of orders right there. I'm not long the euro dollar, but I am in a couple dollar pairs. Honestly, the euro dollar is actually one that I do see a potential of going back up. I kind of hope it doesn't go back up because I get paid in dollars. So I'm kind of hoping the euro dollar is going to keep going down. I have two rental properties in America, and both of those pay me in dollars. Any money I make off PayPal, Stripe, or YouTube, I get paid in dollars. So yeah, I kind of hope the euro dollar tanks back down to parity, but more than likely, it's probably not going to happen. I have been talking about this possibility for a while now, which is a possible ABC on the. I have two analysis for the euro dollar. This could be an ABC crutch into the last wave down. 78% fib bounce, all the way back down to below parity. That's one of my scenarios. That's a monthly time frame outlook, something that would potentially take a year to play out. My other scenario is that this is the expanding, which has been my analysis for probably literally for a year now. I've been talking about this expanding since probably August or September of last year, to tell you the truth. When did this actually turn up? Yeah, it turned up last. Yeah, oh, geez, that turned up in November. So I've been talking about this expanding for probably almost 2 years, honestly, at least 18 months. But it doesn't have to be an expanding. If it is an expanding, I think it's going to go up to 1.34. If it's not an expanding and it's actually just a crutch into this wave down, which it definitely could be, then it potentially could go all the way back down below parity, which honestly is kind of what I hope happens. I hope I'm wrong about it being an expanding. I hope it does go down because I like it when my dollars go further in Europe because I like to travel in Europe. So it's nice when when it's a little closer to parity. So, anyways, what do we have? Anybody else have any requests other than the dollar pairs they want me to look at? We got about 11 minutes until the PAL speed starts. 10 minutes and 26 seconds. If you haven't done so already, definitely do check out my website. There's a little video right here you can watch that explains everything. My membership is extremely cheap because I'm not looking to get rich off my membership. I'm looking to get rich off my trading and my passive income from rental properties and T-bills. I put a lot of my trading profits in T-bills. I have almost a hundred and almost $120,000 in T-bills right now that I'm sitting on. So my membership is not what pays the bills, that's for sure. But so the $30 a month, if anybody's interested, there's a little video right here you can watch to learn more. But the website is fxpipcollector.com. Check that out if you're interested. Very, very cheap membership. Unfortunately, because of scammers, my free Discord channels are going to be gone probably by next week. Anybody that is already in there, and I know 100% is not a scammer, like Joseph, he's in the chats. He was in here today, Trader Joe. You'll be fine. You'll be able to stay in the group. But anybody that I is not actively in the group chatting and doing and participating is gone. So this is literally the last week of the free chats. Anybody that's already in there that I know is not a scammer can stay. Everybody else is not welcomed anymore. Two people got scammed out of almost $1,500 on my Discord channel 2 weeks ago. And because I'm not gonna allow somebody to join my Discord channel, which is free, and then they get contacted by fake FX Pip Collector accounts, and then they get scammed. So I'm not going to allow that. They contact people with fake accounts pretending to be me, and then they ask them to sign up for a brokerage. One guy put 1,500. One guy put $750 into a brokerage account, and another guy put about the same, and he put about $900 into a brokerage account. So they pretend to be like a broker. They have a website and everything. And then once you put your money in there, it's gone. It's probably in India or Africa, Thailand or something, or who knows where it is, but it's gone forever once you put your money in. So be very, very careful. And if you get contacted by somebody, it is not me. I would never, ever contact anybody, especially asking for you to join like a brokerage or something. That's just complete silly. But because of the scammers and because people are losing money, I am not going to allow people to join my free channel and then get scammed anymore. So if you're there, then you're more than welcomed. If you're not in my group, then sorry, you missed out. The members only group, which is all these channels down here, which I share every single trade I take with the members in here at the time of entry. These are all my trades over the last several months, you can see. These are all my trades over the last several months. So the free channel, the members only channels will stay. And the only way you can get into the members only channels is by joining through my website, fxpipcollector.com. I don't have the Aussie index. Oh yeah, sorry. If you got kicked out, it's because you are not active in the group. And if you're not active, then I do not know that you're not a scammer. So because of that, you probably got kicked out. So sorry about that, but I'm not, like I said, I don't want people to lose money just because they join my Discord channel and get scammed out of fake accounts. So I am getting rid of it. Plus, it costs a lot of money to run that free channel, believe it or not. So yeah, let me look at Bitcoin and Nasdaq. Nasdaq is the same analysis as Bitcoin, as the S&P 500. So exactly the same analysis. I think we're getting very close to a reversal, but I don't think it's here yet. Maybe non-farm payroll or CPI next week could cause a reversal, but same exact analysis. I think we're in a wave five. I think we're in a fifth wave extension. I think this is a one, two, three, four, five of five. I think it's getting very close. You know, maybe within a week or so, this thing could turn down. And if it does turn down, it probably will at least take out this low right here, right around 20,600 on Nasdaq. But for now, I would definitely still be recommending longs 100%. Oh, wow, that really looks like a wave B, though. That really looks like a wave B, like it's going to go down one more time before it goes up. So I think it's actually going to go down one more time before it goes up, potentially. Definitely looks like a five-wave downtrend. Definitely looks like a corrective three-wave pattern. It's probably going to make another five waves down before it goes up. I got all these sort of time frames on there because I was working on tuning my time frames a little bit. I don't really trade the short time frames. On the euro dollar, I definitely will. Let's look at VIX real quick. Thank you for reminding me, because that is actually a pretty good indicator of what the stock market is going to do. VIX. You kind of can. Oh yeah, it is very low. Definitely. There's no Elliott wave analysis on the VIX. You know, there's no Elliott wave analysis. I don't even know if Fibonacci analysis would work on this. It's not really a normal chart, unfortunately. It's just you get these basically fierce spikes. So it is extremely low. So there's probably a good chance it is going to go up at some point, isn't there? And it did make an impulsive move up. So maybe we are getting ready to make one of these little fear spikes. Maybe the stock market is getting ready to go down and the dollar potentially getting ready to go up a little bit. Like I said, there's really no Elliott wave analysis on this thing. I don't even know if Fibonacci analysis would work. I've never even tried it, to be honest with you. Was that a fib level? Yeah, it was a fib level, pretty close to it. That was definitely one, two, three waves up to a fib level, so that definitely worked there. Oh, okay, nice. Nice, nice, nice. Probably a pretty good chance it's going to go up at some point, but I don't know. I don't really know what I would do for analysis on this thing. I'm sorry, but I don't really think Elliott Waiver is going to work on this thing. Yeah, it did make five waves up, didn't it? One, two, three, four, five waves up. So maybe it's going to go down like this and then go up like that, like a wave A, one, two, three, or something like that. Either this would be like an A, B, or it's a one, two, maybe. Yeah, Nvidia, I got it right here. Nvidia should be going up because of all the AI. Yeah, I was gonna say yeah, because of all the AI stuff. Can you imagine? Talk about buy and hold. Holy crap, huh? Wow. When you're in all-time highs, the only thing you can really do is put a Fibonacci extension on there to get support and resistance levels. That's like the only, there's nothing to use for support or resistance when you're up there. Yeah, that's one hell of a trend. I honestly think Nvidia is probably not because of all the AI technology and the rise of AI and everything else. This is probably not even close to being over. It might make a pullback at some point, and this looks like a one, two, three. It looks like we're in the middle of a wave three right now. If it is a one, two, three, then I guess I could put a fib extension on there to get a projection for the wave three. But I think it's already beyond the 161. Oh yeah, that's at the 278% Fibonacci extension. So I've seen the wave threes go all the way to 378%. So I mean, this thing doesn't have to stop here. That's for sure. Most recent structures right here. As long as it doesn't break that low, I would definitely continue to be bullish. It definitely looks like we're in the middle of a wave three. I would definitely use these higher time frame fib levels as areas of support and resistance because they're going up. So my next big area of resistance would probably be 3,420. And then if it goes beyond that, my next area of resistance would probably be 3615. RIG. Boy, I remember that, but I don't. Oh, because it's not even a thing anymore. Let's see. 2 minutes until power starts. Finally, I got it all queued up so we can watch it together. I'm not gonna talk through the speech because I want to listen to it also. I definitely do not trade ICT. I'm actually ICT hater because I think he's a scam. The guy who made ICT, the ICT guy, I think is a huge scam. But I do think that some ITC stuff works. Yeah, definitely gonna draw the devil face. Some of the ITC stuff definitely does work because he stole all the ICT stuff from from trading strategies that have been around since probably the 70s. ICT works because he stole all of his information. I all the stuff he talks about is stuff that's been around since way before his time. It would literally be like me labeling something as labeling this as a 1, 2, 3, 4, 5, and then instead of calling this Elliott wave, I would call it FX pip waves or something. Oh, this isn't an Elliott wave. This is an FX pip wave. We want to go long at the end of a wave two on the FX pip wave. Oh, they definitely work. I'm not saying they don't work. I'm just saying that ICT stole all of that information and he rebranded it. It's like taking Heinz ketchup and slapping your own label on it and then reselling it. It definitely works. I just think he stole it. And I think he's one of the biggest scammers in the world. He's proven many, many times that he doesn't really do very good in scammers. Yeah, Joe is on Discord. He is Trader Joe on Discord. I don't really use ICT stuff. I think order blocks definitely work, which is definitely not an ICT thing. That's been around forever. And I definitely think that fair value gaps work, and that's not really an ICT thing either. That's just a liquidity area where the market pushed really hard and there's still a lot of leftover liquidity. So the market will often come back to that leftover liquidity and grab it before it takes off. So these are all concepts that have been around for, 40, 50, 60 years probably or more. All right, we got Powell, so let's get ready for him. The Discord channels are still available if you join through my website. If you become a member on my website, you can join my Discord channel still. But the free Discord channels are not going to be available anymore unless you're already in there. So check out my website if you're interested in joining. It's fxpercollector.com. It's only $30 a month. It's extremely cheap.
Briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
Just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Thank you, Mr. Chairman. You took out the word or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still, a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well looking ahead.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable. Which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because if it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So as long as that puts the labor market in balance. The fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you, and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody, and also from a dissenter, is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table, where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who, I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think, all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. Um, we're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to slightly looser policy.
Nick Timmeros, the Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of 30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do too unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say, when you think that the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
You know, that's, you know, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals. And that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that. And it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Hi, Victoria Guido with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, you know, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work. And I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometime early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
The other thing I wanted to ask is, are you comfortable BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorize spending as the administration proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too. So it's quite important for our economy, and certainly for the Fed's work and other government agencies' work, that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're showing coming in, showing no significant upward trend in inflation over the past 6 months, that the wait and see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait and see approach is giving
the wait and see approach. What do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait and see approach.
Well, so that's where policy is restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, I would say, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance. What may be giving some companies will certainly be taking advantage of the fact of the tariffs and all the discussion of how they're going to. Companies will raise prices when and as they can, and you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often they'll cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate, or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to, and we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down?
I think
closer to 2.
We'll look at everything. It's as I mentioned, a pretty reasonable base case is that this will be a one-time price increase, and in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right, so and if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target.
So this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts when they come out in years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
Just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping, and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
We're monitoring the situation. We do, of course. As you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But we really need the government data. Really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that, but if we'll have to make do with what we have. But I certainly hope that we get what we need.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, it would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Afternoon, Sir Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Um, Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer is in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing, but so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was again right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting. Some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about in sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even low, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance. Oddly enough, you've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor forces is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So we have an economic go around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go around. All the way around the table, everyone gives their views. So the discussion around policy was the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing the next day or so. So, but that's the story, and I would say well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation. That's the nature of a supply shock. And it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you said you're waiting to be confident inflation is heading toward your 2% target before you start cutting rates. When you do get that confidence, would you be in favor of lowering rates right away?
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because inflation is above target. When we have risks to both goals, and one of them is farther away from goal than the other, and that's inflation. Maximum employment's at goal, so that means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is the final sales to private domestic purchasers. That was down to a 1.2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wondering if you look at that, you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak. And the inflation numbers from GDP today came down 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%, but it's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised, after the fact. The labor market data we still think continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, and again, trying to do the right thing in what is a challenging situation, because you're being pulled in 2 directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not gonna say that. No, I just think we're gonna need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're gonna make a judgment based on all of the data and based on that balance of risks analysis that I mentioned.
Thank you.
Thank you, Chair Powell. Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on the decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
Okay, it is over. Just about fell asleep over it. I hate watching these pal things. They're pretty boring in my eyes. He kind of says a lot, but he doesn't really say anything. It really reminds me of a boss I used to have. He says a lot of information, but he kind of doesn't really answer any questions while he says it, so it's kind of interesting. He's a really good talker for sure. I actually don't really mind Pal. I think he's pretty good. So, anyways, honestly, the trend traders are, as usual, the trend traders, the people that are trading with the trend until they get a reversal, are doing pretty damn good. Right now, the most recent structure on the euro dollar is way up here. Anything we see to the upside, unless it breaks this structure, we have to kind of assume could just be a correction to the last 5 waves down. So, I mean, the trend is 100% still down on the euro dollar. We definitely have 5 waves down, so I'm still thinking we could get a bounce. If that bounce goes up and breaks this high, then I will definitely become bullish. If that bounce just makes another 3-wave pullback, some sort of an overlapping pattern, then I would definitely stay bearish. Same thing on the pound dollar. The pound dollar also has 5 waves down, in my opinion. 1, 2, 3, 4, 5 waves on the 1 hour. Maybe a little better seen on the 30-minute. So if it goes up and breaks the high of those 5 waves, then that would turn me very bullish. If not, anything we see to the upside could possibly, especially if it's an overlapping pattern, could possibly be a very just another correction to the downtrend. So I mean, nothing has really changed. They didn't change the rates, which definitely didn't change the trend. The trend is definitely still down. Most recent structure on the Aussie dollar is right here. This is the structure that would turn me bullish. If it breaks that, then I will definitely become bullish. If it doesn't break that, then I will definitely continue to look for 1, 2, 3-way pullbacks, Fibonacci bounces to go short again for the continuation of the downtrend. Same thing, Kiwi dollar. Same thing, 1, 2, 3, 4, 5 waves down. Most recent structure is right here. If it breaks that high, I would become very bullish. If it doesn't break that high, even if it does turn up, I would assume that the turn up is nothing more than a pullback to the last 5 waves down. So that, you take it one step at a time, you're going to be a lot more better off on these markets, that's for sure. So US dollar Canadian, actually the most recent structure on the dollar Canadian is way down here. It could break this structure right here. That doesn't tell me that the trend is over. That just tells me that the last 1, 2, 3, 4, 5 waves is over. It could potentially just make a pullback to those 5 waves and just keep on going up. It doesn't even really have to do that either. I mean, it could potentially just keep on making higher highs, higher lows from here also. US dollar Swiss, same thing. I mean, this is the most recent structure way down here. If it breaks that structure right there, then that would definitely turn me very bearish. If it doesn't break that structure right there, then anything I see to the downside, I would most likely just assume is nothing more than a correction to the uptrend. It could break this structure right here. That doesn't tell me the trend is over. That just tells me that the last 5 waves is over. So definitely still very bullish on that. US dollar yen, which is actually one of the ones I was kind of eyeballing for a possible entry. Most recent structure is right here. If it breaks this structure, that doesn't tell me the trend is over. That just tells me that the last 1, 2, 3, 4, 5 waves is over. It could potentially make a correction to those 5 waves and continue the higher time frame uptrend. And gold. Gold, I personally think that gold is turned down. I think eventually gold is going to hit $3,000 and it may even go down to 2,950. Now that doesn't mean that there potentially couldn't be some big pullbacks, along the way. There could be bigger pullbacks, but I think in the daily time frame, it will continue to make lower lows, lower highs. I actually think gold is extremely clear on the daily, weekly, and monthly. We got 1, 2, 3 waves down. We got 1, 2, 3 waves up. We got 1, 2, 3 waves down for a wave Y. So definitely still bearish on gold. I was hoping for a bigger bounce. To tell you the truth, I was short from up here. I got out around here because that was the breaker structure with a 750 pip profit. Then I was hoping to get a little bit of a bigger pullback to go short again. It didn't really make that big of a pullback. It only made a pullback to the last wave down. When the market is continuing to trend, every pullback is just a pullback to the last wave. This pullback was only a pullback to that. This pullback was only a pullback to this. This pullback was only a pullback to this. This pullback was only a pullback to that. Until you get a break of that low high, low high, low high series, it is definitely a downtrend. And I would definitely continue to trade with the trend. Like I said, I personally think in the next several weeks, maybe a month and a half, gold is likely to get down to 2,900, maybe 2,950, someplace in that area. So definitely very bearish on gold for sure. So anyways, if you are interested in joining my premium membership, then the link for that is fxpipcollector.com. It is only $30 a month. There's a little video right here on the homepage of my website you can watch. It explains everything. $30 a month is extremely cheap, and it's the only way you can access my Discord channel anymore. So if you want to access to my Discord channel, that's the only way to do it. So anyways, that's it for now. I will make my PM videos, and those will be out in about 40 minutes. And until then, I will talk to everybody tomorrow morning in the London session. Have a great night, and as always, happy trading to everyone.